So we talked now about a few of the financial priorities a widow faces, and taxes are one that we haven't covered yet. Specifically, how taxes may change after losing a spouse is a topic that can carry a lot of weight and anxiety for widows. So tax planning now becomes an even more important part of wealth planning during this transition as we think about how this life change will affect the taxes you pay over the rest of your life, and what we can do to potentially reduce those taxes. Now, there are a few tax rules that become especially important after losing a spouse, and the challenge is that most people simply aren't aware of them or how they are affected by these rules. Now, the first one involves the year the spouse passes away. In that year, you're still allowed to file taxes as married filing jointly before almost certainly switching to a single filing status after that. And that's a bigger deal than it sounds, because tax brackets for married taxpayers are significantly wider than they are for single taxpayers. And so that just means that the same amount of income can often be taxed at lower rates when filing jointly. So when we're doing planning, we often take a careful look during that final joint tax year, and we have to ask a few thoughtful questions. Number one, does it make sense to withdraw or convert some traditional IRA money to a Roth while those wider brackets are still available to us, and we can pay those lower rates than we will here in the very near future? Second one, should we intentionally realize some capital gains while those rates may also still be lower? And I think a big element that's really unique in each and every case is just making sure that the timing of any of these decisions and strategies is appropriate, making sure it's not rushed, and making sure everybody understands what we're doing and the benefit of it but before we do anything at all. I'd say the second thing that catches many people off guard is what happens after that year. So even if someone's income stays the same or might even decrease, their tax bill may actually increase. And a big reason for this is, as I mentioned, single tax brackets are tighter than married brackets. So income is going to be taxed at higher rates more quickly. So things like Social Security taxation, capital gain taxation, even Medicare premiums, these are also influenced by income levels once someone is filing as single. And on top of that, the standard deduction, which helps offset income, that's also cut in half for single taxpayers. So, first, we want to recognize if taxes are going to be higher and make sure that tax withholdings are adjusted appropriately, because we don't want any surprises at tax time. We don't want a big balance due notice from the IRS or when we file our taxes. But then we want to take a step back and we want to look ahead and maybe identify if there might be some planning opportunities to pay taxes at lower rates earlier on to avoid the even higher rates that might come down the road. Sometimes it makes sense to strategically realize income sooner. So we might withdraw or reposition retirement funds earlier and over time, rather than waiting until required minimum distributions or RMDs from retirement accounts eventually force income into higher tax brackets later in retirement. So the goal is really just to have awareness over how things are going to change and avoid those surprises, and then B, hopefully have the ability to create some tax savings through thoughtful planning. The third area that's really important involves something called a step up in cost basis. So when someone passes away, taxable investments and assets that are held in their name receive a reset in their tax basis. So put simply, that just means that the accumulated gains up to that point essentially disappear for tax purposes. If the asset was held jointly with both spouses' names, it typically receives a half step up in basis, meaning half of that gain disappears for tax purposes. So it'd probably be easiest to use an example. Let's say a late spouse owned a stock in their brokerage account that they had paid $3,000 several years ago. That's their cost basis, $3,000, and now it's worth $10,000. It's grown quite a bit. So if they had sold it before they passed, they would have owed taxes on the $7,000 of appreciation over their cost basis. After they pass, though, that cost basis that used to be $3,000, if they haven't sold it, it's now reset to $10,000 for the surviving spouse to inherit, if they're the beneficiary, of course. So this is an extremely valuable rule because it allows that surviving spouse to sell investments that may have been held for a long time and have grown a lot, but to be able to do that, to be able to sell those assets with little or sometimes no capital gains tax anymore. And so now this becomes an opportunity to maybe rebalance a portfolio, reduce large positions that might pose some risk to the financial plan, or maybe even sell a burdensome real estate property that you don't want to deal with anymore, and do these things with little or no tax consequence. So when handled very carefully, these kinds of planning decisions can make a really meaningful difference over time.